Hello and welcome to episode number 16 of the educational series. My name is Zach Tussle. Thank you guys for joining me today. Today we have a very important question. Get asked this question all the time. How much money will I need to retire? Now it's going to be different for everybody, so make sure you stick around. So, before we talk about how much income or how much money you'll need in retirement, what I do with every single client that comes in here is talk about how much debt they hold, because we need to back into the numbers. So let's do an example. Let's say I have a client who makes $10,000 a month, $120,000 a year. But right now he's paying a mortgage payment for $3,000 and he's paying a car payment for $500. So out of the $10,000, he's actually only living on $6,500 worth right now. Now when he goes into retirement, we'll talk about how do we get the house paid for? How do we get the vehicles paid for so you can go into retirement debt-free? Being debt-free in retirement makes a big deal. It lessens the burden you'll have to draw off of your IRA, 401k, or other qualified plans during retirement. And since you're making $10,000 now but only living on $6,500, if we were able to get $6,500 after tax in retirement, you would continue to live the same life or the same kind of life that you do now during retirement. And that's what we strive for with all of our clients. So now let's talk about how much money you might need during retirement. Now we're going to keep going with this example. Everybody will be different. If you need more money during retirement, you just have to save more money along the way. But let's say, for example, you were to retire with $1 million. Now that could be in a 401k plan, it could be an IRA, any qualified retirement account, or it could be unqualified money, like a single account. A prudent drawdown rate, or industry standard, is 4%. So you take $1 million times 0.04, gives you $40,000 a year income. Now you will have to pay tax if it's a qualified account like an IRA or a 401k. If it's a single account, you won't have to pay tax as long as these aren't gains in the account. So let's talk about if you need more or if you need less than 4%. Most advisors out there say that 4% is the prudent drawdown rate in an account. Obviously you can go over 4% or under 4% depending on the income you might need from the portfolio. But 4% is a comfortable number where we can invest the money in the market, keep that account growing, or keep your $1 million growing each year, and then also provide the 4% off the account, usually just through dividend-paying stocks and the like. So let's talk about income now versus income in retirement. First, we got to back out the expenses we currently have that we won't have, or we hope we won't have during retirement if we plan the right way. First, we're going to stick with our $10,000 a month example, $120,000 annual salary for the year. Out of that $10,000, $3,000 is going toward a mortgage, $500 is going toward a car payment, and let's say he has 2 kids that he's helping through college at this point to the tune of $500 a month or $1,000 a month total. So you take $3,000 plus $1,000 plus $500, it comes to $4,500. $4,500 times 12 or 12 months out of the year, he's spending $54,000 of his salary right now just on expenses that he hopefully won't have during retirement. So 120 minus the 54,000 brings him to 66,000, or what he's spending out of his spendable income right now. So $120,000 minus the $54,000 per year of expenses brings him to $66,000, which he's actually living on right now. Now we're always going to have things like the power bill, the water bill. You hopefully won't have the mortgage payment. You won't have the car payment. You'll always have medical expenses and other things. So we can't factor those in because they'll never go away. But the things we can control, or the things we can pay off before retirement, we can certainly factor those in and take them out of the equation. So how much money is he actually living on now is $66,000, even though he's making $10,000 a month or $120,000 per year. So after you figure out how much you can take out of your retirement account, which the golden rule being 4%, or the rule that we like to use for most of our clients here, 4%. $40,000 per year. There's other things to consider. So you might have a pension plan out there. If you're a local employee here with Duke Energy or Freightliner, you might have a cash balance plan. Your wife might be getting Social Security, or she might have a pension from teaching or some other profession she held in the past. Normally, we can get up to $2,000 per month through Social Security or through an old pension plan somewhere. $2,000 a month times 12 months during the year brings that income stream to $24,000. You add $40,000 plus the $24,000 will get you to $64,000 per year during retirement, which is actually only $2,000 less than you're used to living on right now. So that's the goal for most of our clients here when they retire, to be making the same or almost the same income as they were when they were working. And as long as we're doing that and we can keep the account growing slowly over time, we know we're doing our job. So the last thing we're going to touch on today is, what will $1 million be worth 20 years from now, or what was $1 million worth 20 years ago? So to do that, we're going to talk about the Consumer Price Index. There's a ton of stats out there. You can go out on the CPI index and you can talk about cost of a house, cost of a gallon of milk, cost of a hamburger. I just picked a gallon of milk because everybody knows what a gallon of milk is, and they buy it all the time. So we're going to talk about price of milk in 1980 versus 2000 versus 2020. So 40-year time horizon. Gallon of milk back in 1980 was $2.16. In 2000, that same gallon of milk was $2.79, representing a 29% uptick in the price of milk. And in 2020, that same gallon of milk was $3.52, representing a 26% price increase. So, what does that mean for you and your retirement portfolio? As you're saving over the years, $1 million today will go much further than $1 million will go in 2040. The same thing applies to 1980. If you were to retire with $1 million back in 1980, cost of living was much lower then. Your $1 million would have gone a lot further. That same $1 million won't go as far in 2000, and then certainly won't go as far in 2020, let alone if you're saving for retirement now and the plan is to retire in 2040. So keep that in mind when you're planning for retirement. If you're looking at these numbers roughly, 26, 29%, call it 30%. 20 years from now, you might need 30% more in your portfolio to retire and buy the same things, buy those gallons of milk during retirement. So keep that in mind. So that's it for today, guys. I hope you learned a lot about how much money you're going to need to retire. And no, it won't be the same for everybody. I would encourage anybody out there to make a plan, sit down with an advisor somewhere, figure out what your living expenses are now, what they will be in retirement, figure out what debt you can pay off before you get to retirement to ease the burden of those retirement accounts when you're drawing off of them. Well, guys, thanks for tuning in. I will see you next time.